Good morning. I'm Scott Redler, Chief Strategic Officer of T3Live.com, and welcome to this morning call. Yesterday, another violent day in the market. We came in after a decent reversal after the FOMC, and we were thinking, okay, can this build? A lot of people were saying it was an oversold bounce. A lot of people were saying that this is the start of a new rally. I said use your retracement rules. Yesterday on the open, we sliced through both set of retracement rules that I defined for you, which took away the momentum second or third day move right off the table. So right away, you almost had to play defense once again. Okay, and then last night, Cisco came out with some good news. You saw a bit of a bounce in some of the indices overseas before, coming back in. And now we're in the same exact situation we were, where we're in this lower pivot area of the market trying to figure out, was this enough of a downside move, or do we have further to go? Now, what I want to say is, from my past, from experience, is that violent moves usually lead to more violent moves, meaning when you have a drastic down move like we've seen in this market, typically it doesn't stop here. It leads to another one after a pause, after you work off some of that oversold condition. There's talks now that France might get downgraded. The French banks were under attack. I'm seeing the same type of movement in stocks that I saw back in 2008. And the only reason why we were successful back in 2008 is because we took our opinions off the table. We let the market do the speaking. We didn't get too aggressive. We played levels versus levels, and we put together a plan in order to react quickly, because this market's moving very, very quickly. So if you take a quick look at the S&P right now, let me show you what I'm seeing. Obviously, the head and shoulders top already ignited, already happened, and that's what helped trigger this move all the way down to the 1120 area. So if you sold correctly, you sold about 8-10% ago. Some guys even made money to the short side. So now what's important is this lower range. Okay, we have a new lower range in the market, whereas this was the reversal day on Fed Day. Look how much it took back, well more than 50%. So right there, that took some upside movement off the table. So now, if we were to start breaking on these spiders below 112, and then you have the low of that day of 110.27, we could see some further downside. So if you go to the weekly chart, which I'm going to show you, where you could see bigger support, okay, I see much bigger support in the spiders weekly chart coming into this 1010 to 1040 range. So here's the thing, okay, if you sold correctly and you put money to work in this discounted lower range, hopefully you did tier one. Now, if Alex was here, she'd say, what's tier one, Scott? And I would say lightly invested, either lightly invested or cash, because the market still has a lot to prove. If you're looking to do a tier three, accumulate into this dip, which is hard to do, and you should only do that if you have the financial wherewithal and you're very comfortable in your life and you know your risk, then you already put tier one in this lower range right here on the chart. You already did it in this area, so I would not be adding any more, even though we just came in pretty a sizable move. I would think you wait until we get into this area before getting into a tier two. Or if this area holds long enough and we start to get going to the upside and we get some follow through or we get some better action and more clarity, you add to when it's working. So only tier one at best here. I'm also going to show you, a chart of the Dow. I haven't done that in a while, and I know a lot of the public out there uses the Dow. I use the S&P 500 as a better gauge. So if you take a look here on the on the Dow Industrials, same type of scenario. You had your head and shoulders top, left shoulder, head, right shoulder. If you sold your stocks correctly, you would have been selling it around 12,000. You would have saved yourself about 1,300 points of pain. If you bought into this support area, thinking you just want to take a buy the dip approach down 1,000 or so points, you do the same strategy. Okay, you do tier one into that area, which means lightly invested at best. Okay, and then be prepared that if we go down further, we break this lower pivot, we can easily see this level in the Dow, which is right here. Okay, you see this support all the way back from last summer. There's no reason why we can't be testing 10,000 or 9,600. So if you did put tier one to work here, you better make sure you're ready to put some more if that's your thesis. Do not go all in here, because we can easily see that. And if you look at where we came from, we're still well above the lows from that March. I'm not predicting a doomsday, but I do think that this is very feasible. If you sold here and you already started buying back a little bit, 1,000 points on the dip, you still can go that way. So what I'm trying to say here is don't do something that's out of your comfort level. If you're going to navigate the market, make sure you know what you're doing. If you think because we went down 1,000 points, it's a great spot to go all in, it's not. We can go lower. I'm, as a professional, going to trade levels versus a level. I'm not doing the accumulation game. I have to be at work every day, maneuvering the markets both long and short. But until I see a better formation at day one, the follow-through, I'm not going to be putting tier 2 or 3 to work for the long term. Well, there'll be a time and place for that. So what I want to show you in the second